So general consensus seems to be that they're going to come down to the wire and then make a deal. I think the risk is that the market might be underestimating the probability of going days or a week over that line and having some sort of technical default for a period of time. For me, because I'm not a political strategist, I don't have a lot of insight in the probability of those outcomes. But what I am focused on is what happens after the debt ceiling. I think there's so much focus on the debt ceiling itself. There's not enough focus on what happens after the debt ceiling. And so for the past 6+ months, the story's been Fed quantitative tightening, raising rates. But something that's not been covered enough is that the Treasury has actually been offsetting a lot of the Fed's tightening. The Treasury has been emptying their cash account into the financial system. And partly that was because they had too much cash in their account to begin with compared to their target. But then starting in January, the debt ceiling actually made them lower their cash account. So when they were in a situation where they were no longer able to issue new debt, one of the ways that they deal with that is they say, okay, we have an existing cash balance that we can begin drawing down. And so their target is to have about $500 billion in that account at all times. In their preferred environment, that's what they would do. But in recent months and weeks, they've drawn that down to under 100 billion, which is way below their target because they still have bills to pay, but they're not able to issue debt. And ironically, while that's happening, while that cash is draining out of this Treasury void and back into the financial system, it's actually offsetting a lot of the QT that's been happening.
So they're nullifying each other. They're canceling each other
Exactly.
out.
They're nullifying each other. But then the question becomes, when they actually solve the debt ceiling, if the Fed wants to keep doing quantitative tightening and the Treasury is no longer emptying its cash account because it'll be practically empty, and then if they want to refill their cash account back up to their target, then it's like a double negative for liquidity. Because they're actually joining the Fed in pulling liquidity out of the market. And I think that's where you could get breakage. If things surprise to the upside in terms of how bad they get, I think it would be because the Treasury does not manage that refilling process well. If they, for example, if they shorten the average duration of the treasuries that they want to issue, then they can probably handle it more smoothly because they can probably get money out of the reverse repo market and into their T-bills. If they try to refill the Treasury account quickly, or they do it too much with longer duration bonds, they're more likely to cause yet another liquidity crisis because they risk pulling that liquidity out of the banks that are already very liquidity constrained.